歡迎嚟到肥力士 channel。嗱，都算係咁啦，安排咗個 webinar 可以適合我哋好多香港人咧去了解究竟而家我哋嘅 residence 係點啊 ，split year 係點啊，跟住咧仲問咗好多唔同嘅香港問題，希望有一啲咧可以幫你去解答到你心目中嘅問題。可能當時你冇問到，有其他人代你問咗，希望呢一度可以幫到你啦。我要補翻呢一段先，你見個天都黑晒，因為我剪緊片，突然間我收到一個 email 咧，就係話佢有25% 咧 off 俾你哋登記去用呢個系統。嗱，本身咧用我而家呢條 link 咧撳入去嘅話咧，你就會開咗一個 page，咁呢個 page 咧就入咗去佢哋嗰個 GoSimple Test 嗰度啦，跟住你碌落底下咧，你喺呢度揀咗免費嗰個咧，其實你揀免費都 OK 嘅，因為免費已經俾你用晒佢裏邊嘅功能嘅啦。除咗你係generate唔到 report 啫嘛，咁亦都係 submit 唔到俾稅局啫嘛。咁但係你一用本身任用噶啦。咁但係而家你用呢條 link 入咧，你仲可以有25% off。如果你係決定用佢個系統嘅話，咁所以咧而家 no harm 去 try 佢個 system 嘅。咁你登記咗先，因為登記係免費嘅。到時你真係需要去用佢咧，你先喺個 system 入邊咧裏邊去俾錢咁樣嘅。咁所以咧而家唔需要急話佢會過你數，因為佢唔會過你數，因為你唔需要俾咩 credit card 資料嘅，好冇？咁你登記咗先，咁啊呢一段咧會攝翻落去我哋而家條片度，咁啊應該你睇到嗰陣時咧就係最新呢一條片噶啦。但係啊個 webinar 咧就當然可以係話好可以再緊張刺激啲嘅，但係唔緊要，呢個資訊嚟嘅，我成日都咁講，你唔知呢樣嘢咧就最慘嘅。即係你知道咗有麻煩啊，有複雜啊，其實都唔緊要。你就算未明白 detail 都唔緊要 ，at least 你知道咗咯。唔好去到一陣間咧，遲啲你發現就冇機會翻身嗰陣時，俾稅局無端端開你 file 開你檔案，跟住同你慢慢計數嗰陣時，你知先至要賠錢。咁嗰陣時點搞啊？係咪先？你就冇準備唔得噶嘛。咁所以而家我哋就話早啲俾大家準備，同你個稅務絕對係息息相關嘅，因為每個人咧個情況都唔同，唯有你自己先幫到你自己。你就算出去俾幾多錢人都好啦，你問條問題都俾500、1000嘅啦，根本冇得問嘅。你唯有就係靠自己知多少少。嗱，你見我病到七彩，我都仍然去幫大家，就係知道咧，我真真正正咧係用心同你哋解決所有嘅問題嘅啦。你要知道肥力士嘅 channel 咧係我主要平台 YouTube， 跟住仲有其他 Patreon 啊、Master Class 啊、Facebook 啊，一切嘅嘢咧都係以5+1個目標咧為大前提嘅。咁跟住亦都安排咗好多咧稅務嘅系統啊，你知汽車嘅保險 broker 啦，仲有 Live in the UK Test， 我攞咗啲免費英文嗰個考試內容俾大家去溫習啦。呢全部都係我同其他嘅 party 咧去安排問，仲要我 filter 過佢哋幫到我哋香港人咧，我先推介俾大家嘅。咁就希望大家繼續支持我嘅 Patreon。咁仲有你 join 咗 Patreon 嘅咧，就唔好離開啦。咁如果你未 join 嗰啲咧，就盡快 join 我哋嘅 Patreon， 等我哋可以再加多啲資源咧，我可以揾多啲人手咧，唔同嘅去支持大家揾多啲資料，跟住仲可以揾唔同嘅 network 啊，跟住揾多啲嘅 supplier， 唔同嘅人咧去俾大家，令到大家可以更容易掌握呢個5+1，唔好即係唔好墮入呢個任何嘅稅網啊，或者係一啲誤會啊，令到大家罰款嘅。嗱，呢啲係啲 reference 嚟嘅，我 keep 住會 update， 遲啲會有個網站咧俾大家睇到最新嘅資料。但係呢啲咧就係話你可以睇到究竟我哋5+1嘅情況係點樣。下邊呢 part 係稅務年度，同陣間個 webinar 嗰 part 咧係絕對有關係嘅。嗱，陣間個 webinar 咧要成個半鐘噶，所以咧你真係唔好介意，即係可能悶，但係其實最重要就係裏邊有好多資料咧，你真係要知嘅。你今日唔知，其實你冇人會話俾你聽噶啦，即係你亦都唔會有人咧坐喺度再同你講個幾鐘頭。頭先淨係嗰2個 simple 嘅 concept， 你知唔知？如果你一中咗 residence 咧，你就已經係需要自動去申報交稅嘅，唔係政府嚟揾你啊！政府唔會話俾你聽你要交稅，係你自己 test 咗自己係 residence， 所以你要自己提交資料。如果唔係嘅話咧，將來就可能真係有排同你計啊！嗱，呢啲咧就係關於買賣汽車個情況啦，仲有讀書嘅情況啦。咁我將佢呢啲 organize 咗一啲圖表咧，就將佢擺喺遲啲個網站噶啦。好啦，咁仲有記得 join 我哋嘅 Patreon， 喺下邊 description 有 link 噶啦。咁之後咧 support 我哋，跟住令我哋更加豐富嘅內容咧，可以幫到大家嘅。好，咁仲有沙晒聲啊！好啦，咁仲有咧就係呢個5+平台，仲有好多嘢可以睇嘅。你之前嚟英國之前啊，嚟英國之後啊，咁所有嘢咧都有晒呢一度噶啦。好，咁而家我哋準備咧就播嗰個半鐘頭嘅片噶啦。咁喺裏邊咧喺右手邊嗰度，你會發現咧右下角喺呢度睇唔到啦。陣間個右下角咧 會係有一啲 Google Translate 喺呢度。嗱，喺呢度右下角咧有 Google Translate 嗰啲，佢因為一路講嘢咧 ，Google 咧同佢即時 translate 嗰啲字咧擺咗喺度。咁所以你知㗎啦，英國音唔係個個聽得到嘅，或者唔係個個聽得晒。咁呢度嘅 translation 都唔係絕對準確嘅。咁但係咧佢係自動去 auto translate 出嚟。咁所以咧你嘗試如果睇到你電腦就睇到咯，如果 mobile 就可能真係好細。咁你 at least 可以有個 reference 好嘛？咁你又聽又睇。咁中間咧佢分咗好多段嘅。頭一 part 咧咁就係關於你個 resident test 啦，你究竟幾時係 resident 啦？中間佢會擺一啲好多唔同嘅問題，啲 Q&A 係我哋之前咧香港人問咗佢哋，咁跟住佢就再 post 喺度，咁跟住佢再解答。咁中間咧我諗夾埋都大概有10條嘅 Q&A 啦。咁佢好似之前好似 total 咧佢收咗大概有40至50條嘅。咁有機會如果佢真係會答嘅話，咁佢可能會咧我問下睇下會唔會佢可以俾到我，跟住我再同大家 share 逐條問題，睇下嘗試我可唔可以再將佢 translate 翻做廣東話俾大家去 understand 咁樣咯。好冇？咁而家即刻去片，個半鐘有排睇啊！好，拜拜。
Hey, hello everyone. Thank you for joining our webinar today, The Expat's Guide to UK Tax. Today's webinar is being presented by the team here at Go Simple Tax. My name's Leanne, and Aidan, who will join us shortly, will be your main host. Before we start, there's just a little housekeeping I need to run through with you. The webinar is being recorded, and all information provided is correct at the time of recording, which is today's date, being the 20th of October 2022. There's been a high number of questions submitted already, which you will see, some of which I've submitted already in the Q&A section on the top left of your screen. We will go through as many questions as we can within the time allowed at the end of the session. Please note, any complex cases we will not be able to comment on and would advise you to seek tax advice. Please still do ask any questions via the Q&A section. If we cannot answer them live here today, we will get back to you with an answer by email. Okay, I think that's everything covered. So at this time, I'm going to hand you over to Aidan, who will start today's presentation. Aidan, if you're ready.
Thanks, Leanne. Can you hear me loud and clear?
We can indeed.
Perfect. Okay, thanks everyone for joining today. We are looking at the Expat's Guide to UK Tax, presented by myself, Aidan Corcoran. A little bit of background about myself. I joined Go Simple Tax a couple of years ago. I have over 10 years of tax experience. And within Go Simple Tax, I work on support as well as help developing new services. ATT qualified and currently sit in CTA with a wealth of tax knowledge, basically from experience. And hopefully I can share some of that knowledge with you today. But before we start, we've got a poll. There'll be a few of these going through the webinar. And hopefully this will automatically pop up on your screen now. And the poll should say, how do you currently submit your self-assessment tax return? So you've got the following options. You've got accountant, you've got paper return, you've got Go Simple Tax, and you've got other digital software. So knowing that there are 100 people on this at the minute, I'll wait until the best part have voted. So if everyone can just simply click the single choice option on your screen now. That's good. We've got quite a few answers so far. Okay, so there's been a leveling off of answers. So just publishing those results, and you can see on your screen that 15% of people use an accountant, 39% use a paper return, 23% use Go Simple Tax, and 21% use other digital software. Thank you everyone for voting on that. Hopefully we can change some of your minds as we go through this webinar with the use of Go Simple Tax, so to say. So what are we looking at today? Well, the content is residence and tax issues. We're going to look at the residency tests, split year treatment per personal allowance. We're going to look at double tax treaties, not going into them in much detail because they are all different Majority of them do follow the same sort of patterns, but each individual country has agreed certain treatment of certain things. So it would take way too long to go through all the different things on that. We'll look at domiciled and non-domiciled, which leads on to remittance basis and making those claims. We have got demo of Go Simple Tax. We'll see how we get on. If we don't manage to do a live demonstration, then I will be recording 2 different scenarios following this webinar. One of a non-resident claiming that they are non-resident and including some rental income, and also a resident person who comes to the UK and has foreign income. There'll be 2 quick demos of Go Simple Tax and the use of it following, provided that we don't have enough time in this webinar. And then we will go through the question and answers that have been asked prior to the webinar and during. However, something that I've not done before, we'll be answering questions as we go along on the basis that some are relevant to certain sections, and it wouldn't make sense not to mention them at that point, especially whilst it's fresh in your mind. Before I start, it is worth pointing out that I am not offering any tax advice on any of the slides in this webinar, and any questions answered should be checked with paid advice with a residency expert. That's mainly because residency is extremely complicated, and not having all the information available on some of these questions, assumptions are being made, and therefore, if there's one minor detail that I haven't assumed correctly, then the tax consequence could be rather large. So the questions answered throughout the webinar have been asked, and I have made assumptions on those. I will identify them as I'm going along, but it's just for your information that this isn't actually tax advice. So residency. How do you determine residency? So well, there are tests known as the statutory residency tests, or SRTs, which I'll probably be referring to them throughout this webinar. They are made up of 3 separate tests, so to say. You've got the automatic overseas test, you've got the automatic UK tests, and then you've got the ties test, or the sufficient ties test. These tests take into account the amount of time you spend or work in the UK, as well as the connections you may have when looking at the sufficient ties. The tests are completed in order, and the order that I've just announced, being first automatic overseas, then automatic UK, and then sufficient ties. And we'll go into these in a little bit more detail shortly. So the actual SRTs, they take into account your tax position or tax residency in the previous 3 tax years. So if you haven't been tax resident in any of the 3, you will have different rules to those that have had previous UK residency. It is worth noting. So to make things easier, if you're resident in the UK for 183 days or more during a tax year, you will usually be UK resident and no other tests are required. I do say usually because we will come on to split year treatment later on, whereby you can make an election to split the tax year into 2. But usually, if more than half of the year you have been resident in the UK, which is 183 days, then usually you are considered UK resident for the full year. For those that are wondering for the definition of days, obviously 183 days, what does that actually mean? Well, it's where you are present at midnight. So if you were to be present 182 days or 182 midnights during the tax year, and then for the remainder of the time you travelled in the morning, you worked in the UK, and then you left, they actually wouldn't be considered days in the UK, or visited the UK, should I say. So what we're going to look at, is the automatic overseas test first. There are 3 tests to take, and basically they take into consideration certain things. So if you meet the criteria of one of these tests, then it gives you your residency answer. So test 1, you'll be considered non-resident for the tax year if you were resident in one of the or more of the last 3 tax years, and you spent fewer than 16 days in the UK. So that basically doesn't give you much wiggle room if you've been resident in one or more of the previous 3 tax years. If that doesn't apply to you, let's say you've been longer than 16 days in the UK, then that test doesn't apply to you and you move on to the next test. The next test being automatic overseas test 2. You'll be non-UK resident if you were resident in none of the previous 3 tax years and you spend fewer than 46 days in the UK. So you're allowed an extra 30 days here, but on the basis that you weren't resident in any of the last 3 tax years. If you were resident in any of the last 3 tax years, then you move on because you don't meet that criteria. You say it's quite simple, but it's really so complicated as you're going through each of these tests, as we'll find out shortly. So that's automatic overseas test 2. Let's say, for example, we have been resident in the UK for one of the tax years, therefore this doesn't apply. We need to go on to test 3. So looking at test 3, this one has a few more specifics for you to meet. So you'll be non-UK resident or non-UK res if you work full-time overseas over the tax year and you spend fewer than 91 days in the UK. The number of days which you work for more than 3 hours in the UK is less than 31, and there are no significant breaks from your overseas work. So, what is a significant break from work? Well, by HMRC definition, you will have a significant break from your overseas work if at least 31 days go by, and not one of those days is a day on which you work for more than 3 hours overseas. Or would have worked for more than 3 hours overseas, but do not have to because you have booked leave. So that is the definition of significant break in this circumstance. On the assumption that that doesn't apply, that is the automatic overseas tests done and dusted. None of these apply, so therefore we move on to the automatic UK tests. So if you are considered non-UK resident, just in terms of the taxation side of things, you'll be taxable on your UK sourced income only. This is usually property income and state pension income from the UK, provided that other income is usually taxed in the country you are resident, and obviously it's worth checking the double tax treaties. The majority, and I say the majority, of double taxation treaties do refer to all income being taxed of where you were usually resident. That is a generic assumption, so don't just assume that that is correct. But from my experience and going through these double taxation treaties, the majority of the time it's where you're resident is where the income is taxed. You should always see tax advice if you're unsure, because the double taxation treaties, as we'll come on to a bit later, can blow people's mind. I deal with them quite regularly, and most of the time I am literally sat there scratching my head thinking, what on earth does that mean? Which you'll see a little bit later on. So moving on to them automatic UK tests. So we've been through the automatic overseas tests, none of them apply. So now we're looking at the 3 tests to take for an automatic UK residency. So I mentioned this a little bit earlier, but you'll be UK resident for the tax year if you spend 183 days or more in the UK in the tax year. Nice and straightforward. Basically, you're in the UK for more than half a year. Moving on to the second test, and again, you'll see that there's a few different conditions that need to be met, and you should note that all of the following need to apply. So you'll be UK resident if you've had a home in the UK for all or part of the year, and all of the following apply. There was 91 consecutive days when you had a home in the UK. 91 consecutive days meaning that you had a home available, basically. So having a home in the UK is something that exists in the UK whereby you could move into and live in at any point. The second point, at least 30 of the 91 days fall in the tax year, and you've been present in that home for at least 30 days at any time during the year. So these 91 days can span over a couple of tax years, but 30 of them actually need to fall within the tax year. This is where it starts getting very difficult, and you would understand the fact that people are residency experts for a reason, because there's so many different variables to take into consideration when doing these tests. And then the third one, at that time, you had no overseas home, or if you had one, you were present in it for fewer than 30 days. So this is basically saying that if you've got a home in the UK, then you were present in it for 30. If you weren't and you have a home overseas, then you needed to be present in that for fewer than 30 days. If you were present in that overseas home for, let's say, 35 days, then but you met the other two criteria, then you wouldn't fall within test 2 for the automatic UK tests. That is basically not completing or matching all of the criteria, all 3 points. So moving on, and again, just a few things more. This is going to be a period which spans over the course of 2 years. Doesn't have to be specific to a single tax year. And basically, you'll be resident in the UK for the tax year if all of the following apply. Please take into account all of the following. If one doesn't actually drop in, then you won't fall within this third and final automatic UK test. So you work full-time in the UK for a continuous 365-day period, whether it is in the tax year or part in it. More than 75% of the period, you do at least 3 hours work in the UK. So that's effectively 75% of 365, and you are working at least 3 hours per day in the UK. And the final one is at least one day, which has to be both in the 365 period and the tax year, is a day on which you do more than 3 hours work in the UK. So again, like I said, this 365-day period can span over 2 different tax years, but provided that one single day in that tax year does relate to UK work, then you would satisfy that criteria. Again, lots of information to take in. Hopefully it makes sense. If this is something that may apply to you, then seeking tax advice would be relevant, because if you are claiming that you're not resident and you actually are, there could be quite steep tax consequences, as we'll see now. So if you're considered UK resident, you're taxable on your worldwide income. If you're taxed in 2 different countries, then foreign tax credit relief is available. Usually you would check the double tax treaty, and the double tax treaty would say that it should only be taxed in one place. There are certain phrases such as may, which basically means that both countries can tax you. But it is worth noting that the majority of the time, if the double tax treaty is in place, then it is only taxed in one country. If there's no double taxation treaty, then unilateral tax credit relief is available. And you should basically have a little look online to see what that means. I think that the UK has the best part of 70% of countries with a double taxation treaty. So the majority do have something for you to look at. But if they don't, and you can't find anything, then unilateral tax credit relief is still available for those that there's no double tax treaty in place. If you're UK resident and non-UK domiciled, which we'll touch on a little bit later in terms of what is domiciled, then you may be able to make a remittance basis claim. So yeah, we can have a look at that later down the line. You should always seek tax advice again if you're unsure. So there has been a question asked prior to the webinar, which is relevant for what I've just mentioned. So if Leanne can kindly split up my voice from the webinar and just read the 2 questions to me, I'll answer them.
No problem. So the first part is, during the 5+1 period of BNO visa, is it tax-free to remit my own past bank savings, just savings from salaries, and exclude the interest earned from a total balance? in the banks of Hong Kong to the UK's?
So in terms of this question, it's a funny one really, because if you are just being taxed on the arising basis, on the basis that you are UK resident whilst on this visa, and all this income has been taxed prior to you coming to the UK, then effectively there'll be no issues and no tax on this capital income from the bank accounts. However, if you are looking at the remittance basis and you are receiving interests earned in the same bank account as this previous defined capital, then it can get a bit messy. And I would always suggest getting some sort of advice. Um, just a quick point before we move on to the next one is for anybody that's looking to come to the UK on such visa, and before they come to the UK and become resident, I would always suggest doing some sort of pre-arrival tax planning with bank accounts to ensure that things don't get messy if you start trying to claim remittance basis and remitting income which has got mixed funds in a bank account. It can get very messy, and HMRC can take advantage of that situation. So anybody that's looking to come to the UK, then I would suggest getting some sort of pre-arrival tax advice.
Okay, thank you. And the second part then is, I receive monthly pension in Hong Kong and have already paid the tax incurred annually in Hong Kong. Can I also transfer that sum of pension to the UK with tax-free during the 5+1 period of the BNO visa?
So from looking online in terms of the BNO visa, I wasn't too sure if there was any sort of tax benefits in terms of things that are paid tax in Hong Kong. Will they then be able to come tax free? So I would say no, unless there is specific treatment. I'm not a Hong Kong expert, so that may be wrong. But from my research and what I'm aware of, I would say no. If you are receiving a monthly pension in Hong Kong and you are resident in the UK, then technically you would be taxed on worldwide income, and therefore, even though it is taxed in the Hong Kong, it would also have to be taxed in the UK. Any tax paid in Hong Kong should be available for some sort of relief, whether it's through the double taxation treaty, foreign tax credit relief, or whether it's unilateral relief. I'm not too sure whether there is a double tax treaty between the two countries, but it's basically, again, tax advice. I don't know the full details, and it would be best going to someone who is a Hong Kong UK residency expert who's aware of these BNO visas and any special treatment for tax that they may have. So thanks, Leon, for that. Which now breaks us up into another poll. And where are you currently based / living? So we have got options of UK, Europe, USA, and other. So again, I'll leave it for 30 seconds. I'll just grab a quick drink and then I'll publish the results and we can move on. Okay, so I'm just publishing these results, and we have got the biggest percentage of 68% in the UK. We have got 3% in Europe. We have got 28% in other, and nobody from the US, unfortunately. So let me just hide those results, and we can move on here. So before we move on, I've clearly included a little cheeky question in here. So if you can help me out, Leanne, please.
Of course, no problem. So the next question is how to report foreign income, for example, bank interest, dividends, capital gains and losses, and rental income.
So in terms of this, I'm assuming that this person who's asked this question is UK resident, and therefore foreign income, all of the below, would be reportable on the SA 106 schedule. for those that have got capital gains / losses, you would also report that on the SA 108. But any tax that has been paid in the foreign country, you would include the relief in SA 106. So SA 106 is the foreign income form that accompanies the tax return if you have foreign income. So on that assumption, that is that. On the other hand, if you are not UK resident and you have foreign income, then it's not taxable. So you wouldn't include it on your tax return at all. So as you can see there, there's two quite distinguishable treatments of this income, whether you are resident or non-resident, which is very, very important that you are getting it right. So moving on to the third test. So we've done the automatic overseas, we've done the automatic UK, and now we're going on to the sufficient ties test, which quite interesting. Oh, sorry. Quite interesting. The third test, the sufficient ties test, now focus on potential ties to the UK. The number of ties affects the number of days that you can actually be present in the UK, and also if you were resident in the at least one of the previous 3 years, or if you weren't resident, then you have different criteria or different number of days relevant for your residency. So this is where it starts getting very tricky, and it is worth noting that the two different tables we'll put on the next slide. But first, let's quickly run through the definitions of these ties, as each tie has its own set of conditions, which can be found in HMRC Help Manuals RDRM 11500. So it's quite interesting, really, when looking at this, because you'll just look at the family tie in terms of what does that mean, whereas HMRC have actually got quite a detailed definition or criteria meeting this family tie. So a family tie is actually created where either an individual's spouse or civil partner is UK resident, the individual's partner, if they are living together as spouses, civil partners, is UK resident, or a minor child under the age of 18 of the individual is UK resident, and the individual sees that child on at least 61 days in the tax year. So if any of those meet, then you will have a family tie. There's more details on that in terms of the minor child and full-time education. Outside of school, if they don't spend time in the UK, then that can have some effects on whether you receive the family tie. So again, look at the RDRM 11500 HMRC manual, and you will have a full detailed basis of each of these ties. Just moving on to the accommodation tie, and an accommodation tie is created if the individual has a place to live in the UK and it is available to them for a continuous period of at least 91 days during the tax year, and either they spend at least one night there during the tax year, or they spend at least 16 nights there if it is the home of a close relative. And the close relative is defined as being a parent, grandparent, sibling, child, or grandchild aged 18 or over. This also includes full and half-blood relatives and those connected through marriage and adoption. So again, looking at that accommodation tie, you just think, oh, they must have a house, but you can see the different criteria that needs to be met in terms of that accommodation tie to be created. So again, I'm not going through everything in massive amounts of detail because it's just a string of different criteria. So on that basis, we'll move on to the work tie, and a work tie is created if the individual has at least 40 UK work days in the tax year. That one's nice and simple. And then you've got a 90-day tie is created if the individual spent more than 90 days in the UK in either or both of the previous 2 tax years. That being the previous 2 tax years. So basically, in the last 2, prior to the one that we're in at the moment, if someone was in the UK for more than 90 days, then they would meet that 90-day tie. And then there is a special tie called a country tie, which is basically if you have been UK resident in any of the last 3 years. Obviously, I've mentioned that there's a different table for those people that have been resident for at least once. So a country tie then is relevant and created if the UK is the country in which the individual is present at midnight for the greatest number of days in the tax year. So for someone, for example, who is a digital nomad who's traveling around the world, if the majority of their midnights were spent in the UK, then they would have that country tie, provided that in any of the previous 3 years they were resident in the UK. So again, not quite straightforward, but it is always worth getting some sort of expert to check over your situation, because you'll see in a second, we've literally got 2 different tables here. So UK ties needed if you're a UK resident in one of the previous 3 tax years. So just flicking back, we've got family tie, accommodation tie, work tie, 90-day tie, and a potential country tie if you were resident at least once. So that's 5 ties. So looking at these ties, if you meet at least 4 of those, then you've obviously got the days spent in the UK, 16 to 45, and going down in number of ties means that the number of days in the UK ascends. I'm not going to sit there and read each line. I'll let let you do that yourself. And whilst you're having a read of that, you've also got UK ties needed if you weren't UK resident in any of the previous 3 tax years. So in this second table, the country tie is not relevant. So if all 4 of the other ties, then you've obviously got, if your days spent are 46 to 90, then you would be considered UK resident, and so on and so forth. Hopefully, that is somewhat informative. It's obviously quite specific. So hopefully, any questions that you may have in terms of any of the numbers on here, it would be best to speak to someone, because it can be rather complicated. So just moving on to split year treatment. And split year treatment. What is split year treatment? So in short, it is the ability to split the year into 2. And when I say split the year into 2, you effectively have a UK resident period and also a non-UK resident period. What are the benefits, you ask? Well, a UK resident is taxable on worldwide income, whereas a non-UK resident is only taxable on UK sourced income. So in order to claim split year treatment, you need to satisfy one of the cases for claiming, and as you would expect, they all have further conditions. So I'm not going to go through each of these cases and explain the further conditions, because there's so many of them. You can see on HMRC manual RDRM 12000 all the cases and additional information that is required. What I can mention is if you are a leaver, then you would be relevant to cases 1 to 3. So case 1 to 3 is basically if you're starting full-time work overseas, the partner of someone starting full-time work overseas, so let's say you don't work and you're following them to whatever country they go to, or case 3 is ceasing to have a home in the UK. And then you also have an arrival or arriver, which is relevant to case 4 to 8. So basically, if you lived abroad previously and you have come to the UK to start having a home in the UK only, so that would be basically you lived in, for example, France maybe, and you were renting over there, you didn't own any property, you've moved to the UK and you've started renting or purchased a house, then you would satisfy that case 4. Case 5 being starting full-time work in the UK. Case 6, ceasing full-time work overseas, usually relevant to those that are retiring. Case 7, deemed departure day. And then case 8, starting to have a home in the UK. Again, I'm not going into the grave amounts of detail for each case. You can find those on RDRM 12000 on HMRC manuals. Again, they're not straightforward, and each case needs to be considered when checking. Apologies for the cough there. I've been holding that in for a while. So that is split year treatment. And we're going to pop on to a question. So, Leanne, kindly break up my voice for everyone, please.
Yes, of course. So the next question is, if I arrive in the UK on the 19th of August and start living in a rented house, which date should I become a resident? How to fill in the date to become resident in the split year treatment? Many thanks.
Thank you. So again, there's not anywhere near enough information on this question to give a detailed answer. Like, do you own a home elsewhere? Is that available to you? Etc. Etc. So on the basis that you've arrived in the UK on the 19th of August and you start living in a rented house in the country that you previously lived in, you didn't own any assets, then you would basically be considered UK resident for the full tax year because you are in the UK for 183 days or more because you come in August. And on that basis, then you would be able to claim split year treatment, provided that this is now the only UK house you own. Only UK house you own / rent, so that therefore is available to you, and any overseas homes that you previously lived in, you do not have access to anymore. So again, not all information is there for me. I've just had to make assumptions, and therefore that is the best I can answer that question. Here is a couple more split year treatment examples. You've got a lever example. So we have got Joe Bloggs, who's 67. He's trying to rent his only home in the UK and plans to retire in Portugal. His wife, Melanie, is retiring and moving with him. They have no other children. They have no children. Joe Bloggs obviously eventually rents his property on the 13th of November and they get a flight the same day. Joe decides to rent for the first year abroad in Portugal. Basically, what is going on here? So if we just skip back, to the cases, and we've got the levers, case 1 to 3. So is he starting full-time work overseas? In brief, no, because he is retiring. The partner of someone who's starting full-time work overseas, nope, she's retiring and following him with him, but ceasing to have a home in the UK. So in this example, they have a home, they look to rent it out, and at the point that they are renting it out, this is considered no longer being readily available to them, and therefore would satisfy the case 3, ceasing to have a home in the UK, provided that Joe does stay in Portugal for the every day, basically for the 6 months preceding the change in residency. He would qualify for case 3. Looking at this situation, Joe's income during the year is pension income and rental income. So he, whilst in the UK, would be taxable on worldwide income. This is only pension income in this example. This is from a private pension, and the rental income starts at the point that he moves abroad. Looking at the fact that he's going to Portugal, I am aware that there are certain visas that give some sort of tax benefit for people who are retiring over in Portugal, and therefore I know that the pension income is not taxable in the UK and it is taxable in Portugal. But under this visa, it is under tax-free status. So that's fine. However, the rental income, because it is UK sourced, the property is in the UK, and he is renting it out from the 13th of November, he will have to complete a tax return and record that income under his SA 105 property pages and pay tax if relevant, if he's over the personal allowances, etc. He would claim split year treatment on this basis because he left after the midway point of the year, and therefore he would be deemed automatically UK resident because he's been there for 183 days. So you can see here that all different criteria now are all being squashed together, and this is where it starts getting difficult and a lot of things need to be taken into account. So Joe, in this example, would have pension income taxable in the UK from the 6th of April to the 13th of November. and then he would claim split year treatment, at which point only the rental income would be taxable from the 13th of November through to the 5th of April 23. And looking at an arriver, we've got Wendy Renard. She is a female footballer who plays for Lyon, but in this example, she played for Lyon and actually got transferred to Arsenal on the 20th of September 2022. She doesn't own any property in France and buys a house in London upon arrival. She's working full-time and hasn't visited the UK before her transfer. So looking at this, Wendy is earning 100k per week. So on this example, 20th of September is before the midway point of the year. Therefore, because she is resident or she is present in the UK for 183 days, I think it's 197 days to be exact, during the year, she would automatically be classed as UK resident. That being said, she would be taxable on worldwide income. However, because she satisfies, if we flick back to the cases, starting full-time work in the UK, case 5, and case 4, to be quite honest, starting to have a home in the UK only, case 4 and 5, then she can claim split year basis on that criteria. You always go from case 1 to 8 in order of priority, and if more than one applies, you can put the 2 different ones that apply. So in this case would be case 4 and also case 5. That is basically saying if HMRC come and question your case 4 claim, then at least you've got a fallback of case 5. In this example, 100k per week, lovely wage there, would be taxable in France, I assume, from the 6th of April to the 20th of September, and then that wouldn't be taxable on a UK tax return, but then following the split year claim from the 20th of September through to the 5th of April 23, you would be taxable, or Wendy would be taxable on that income. Hopefully them 2 examples help, because it is rather tricky and you just need to be making sure that everything is considered when checking. So let's have a look at the next one. So we've got a personal allowance claim. So the tax-free personal allowance is available to all non-resident British citizens. It should be noted that the availability of a tax-free personal allowance for non-residents is currently under review. At this moment in time, the easiest way to find out if you are if you can claim the personal allowance is going to HMRC SA 109 notes and specifically looking at boxes 15 and 16. They give quite a good summary. I'm just flicking this up on another screen, bear with me. Quite a good summary in terms of which box 15 or 16 you can claim the personal allowance in. So just a quick one, box 15, if you're entitled to claim personal allowances as a non-resident because of the terms of a double taxation agreement. So for example, if you're a national of Israel and Jamaica, then you can claim personal allowance in box 15. If you're a national and resident of quite a few countries, Argentina, Australia, Bolivia. This is not the full list, by the way. This is me just jumping through. Japan, Morocco, etc., etc. Then you can claim personal allowance in box 15. Do not put an X in box 15 if you're either a resident of Kenya, Mauritius, or Zambia, or a resident but not a citizen of Austria, Belgium, Luxembourg, Portugal, Sweden, or Switzerland. So it's basically, it goes through a big list of different countries whereby if you are a resident, if you are a citizen, if you are a resident and a citizen, then you need to take into account. That's box 15. And then box 16, as a general rule, if you're a British citizen or a national of another member state of the European Economic Area, EEA, the EEA member states are Austria, Belgium, Bulgaria, Croatia, Cyprus, etc., etc. So it's not helpful if you're not using these. Sorry, you should be using these because they are helpful. As a quick suggestion, this basically summarizes which DTAs contain that grant of the personal allowance. Should a non-resident reside in a country with which the UK has concluded a double tax treaty, the treaty normally restricts the UK's taxing rights to certain income. So, as I mentioned before, income from property will always remain taxable in the UK, and government pensions remain taxable here too. Private pensions do not, as we've seen in the example of Joe Bloggs. UK does have an extensive work of double taxation agreements, and provided they are considered carefully, they should reduce the risk of a taxpayer being doubly taxed. More about this later. So again, as I mentioned a little bit earlier, if there is a double taxation agreement, then usually there is foreign tax credit relief if you are UK resident. If you aren't UK resident, then usually the double taxation agreement says that the income needs to be taxed in the country that you are resident. Usually, as I say, it's a country by country basis, and I wouldn't just assume that I am correct because there's so many different restrictions. So, double taxation treaties, the absolute joy. They can be so complex and often will require professional assistance. They're created to try and ensure that the individual is able to claim tax relief rather than have to pay tax on the same income in two different countries or jurisdictions. Each double tax treaty is different, although, as I said earlier, they do follow similar guidelines, even if the details do differ. Please note that double taxation treaties can exist between any two countries, and it's not just the UK and another country. So it's always worthwhile, as I say, getting some sort of help with these, because if you are dual resident, and you may come across some complex situations. Understanding a double taxation treaty can be difficult, whereas hopefully these 3 points, if you come to have a look at a double taxation treaty, should be able to help and simplify the situation. So firstly, they tend to use the terms the first state, the other state, and that state. When looking at that in first glance, it means absolutely nothing. Until you start striking out those certain phrases and then substituting that with, say, let's say we're looking at the double taxation agreement between UK and France. You would say the first state would be UK, the other state would be France, and you would basically go through this double taxation treaty for each article and substitute those for the country names. That all of a sudden becomes a lot more understandable and easy to read. There's also words such as may and a phrase from one of the double taxation treaties. Sorry, income from property may be taxed in that state in which the property is located. So basically, it doesn't quite give you affirmative details, but the use of may basically says that where that property is located, they basically get first dibs at taxing that income. It does not prohibit the other taxing state, the state taxing the income as well, although you will always get relief from the double taxation treaty elsewhere. So if, for example, this may not be factually correct, so don't quote, but if you have income from, so let's say you're a resident in Switzerland, for example, and you have income in the UK, and it is taxed in both the UK and Switzerland, then you can't stop it being taxed in Switzerland, but you should get somewhat of double taxation relief within that double tax treaty somewhere later down the line. And then moving on to the third assistant help, the word notwithstanding, as in notwithstanding the preceding paragraph. Again, if you're reading that at first glance, you're thinking, what on earth does that mean? But it basically means if you meet these conditions, the outcome overrides, and therefore you can ignore the results of the previous paragraph. So in certain articles, you'll get 4 or 5 different paragraphs, of which the first one says this income is taxable in the state that you're resident, and then the next one will say, notwithstanding the fact that the country that the property is in can tax you as well. So it's basically, you can't just read the first line of each article and say, okay, it's taxable where it's situated. In actual fact, you need to read the full line by line tax treaty for that section and make sure that you are implementing that correctly. Quite crazy and very complex when you start looking at these double taxation treaties. So aside from the double taxation treaties, hopefully that's touched on a little bit. Anything to do with a double taxation treaty, I would always recommend getting somewhat tax advice, because people, if you are struggling, then that is what they have spent endless hours trying to understand these different treaties for. It may be expensive advice, but so, looking at non-domiciled UK residents and their tax planning opportunities. So I am aware that a lot of people on this webinar were in other countries, and I believe that a lot of those are from Hong Kong. So just having a look at this situation. What is a non-domiciled definition? So to be a non-dom, which is non-domiciled, tax person resident in the UK, you will typically be a foreign national living in the UK. While you may be considered a tax resident, your domicile will typically remain as the country of your birth. If you are considered as a non-dom, you will not be able to live in the UK indefinitely. Obviously, the longer that you stay in the UK, you will then come into something that's called deemed domicile rules, which when you've been here for, I believe, 16 of the last 20 years, then you would just fall into a deemed domicile rule. So that's that. But please note, your tax residence status in the UK may change from year to year. So to ensure you are aware of the tax consequences, again, seek independent and qualified tax advice. It's difficult, and it can't just be a two-line question. Usually you need to know the ins and outs of your background, where you've been for the last 3 years. Do you intend to be in the UK for longer? Do you intend to be in a different country, etc., etc. The planning that is involved for non-domiciled individuals can save thousands in tax. I am aware, hopefully this is correct for those people in Hong Kong, that there is no capital gains tax. So for those, like I said before, that are coming on those BNO visas, perhaps rebasing all assets prior to coming to the UK on the basis that you don't get capital gains tax would basically mitigate any gains that you may have if you come to sell whilst UK resident. Just a quick point there, but again, make sure you get some sort of advice on that, as I am not completely 100% sure if that is correct. It's just from what I've seen online, and it made sense to me. Non-domiciled tax planning. So for those that are non-dom, you can choose to have the remittance basis of taxation. And basically, this is where you choose to be taxed only on your UK income and gains, and only the foreign income and gains that you bring to the UK. So this is not the default method. The default method is actually the arising basis, which is taxable on worldwide income. And therefore, the remittance basis claim is beneficial for those that are on that 5-year plus 1 BNO visa, as the first few years in the UK, you can claim remittance basis on the basis that you're not remitting any of that income from Hong Kong, for example, to the UK. Then you can basically save tax. However, if you are looking to bring that income into the UK eventually, it's worth getting some sort of tax plan advice, because once you remit that to the UK, it can open a whole can of worms, and HMRC do quite get on that if you were to remit things that shouldn't have been remitted. Remittance-based claims can be beneficial for UK residents not remitting foreign income. Yeah, so I believe should be a question on the next slide. Oh no. So basically, looking at the taxation table, I think the question's on the next slide. To simplify the taxation of UK and foreign income, depending on your residency and domicile, please see the table below. So looking at UK income, if you are resident and domiciled, you are taxable on the arising and on the arising basis of UK income. Likewise for foreign, you are also taxed on the arising basis. This is taxable on worldwide income, as we've mentioned numerous times. Looking at resident and non-domiciled, UK income is on the arising, However, foreign income is on the horizon by default, but you can make a possible remittance basis claim. For those that are non-resident, domicile doesn't matter, and UK income is on the horizon basis and foreign income is not taxable. So hopefully that clears up where you stand in terms of income and gains when you're resident and domiciled, either in the UK or outside. So, Leanne, if you can kindly jump in. I know we're pushing towards time now, but
I'm here. So the next question is, if my annual income is around 230,000, in what situation is the remittance basis more suitable to use and save tax?
So again, nowhere near enough information in that question for me to correctly suggest certain uses of the remittance basis. Is it the first time you're in the UK? Have you been here for 7 years out of the 9? Have you been here for 14? It completely depends. In short, actually, before I say in short, the annual income is around £230,000 of Great British pounds. Where's that annual income coming from? If 50k is in the UK and 180k is in a different country, then that completely changes what I would say, whether you need to claim the remittance basis in comparison to, let's say, having 200k in the UK and 30k in a different country. So again, I need so much more information before I can safely say what would be the best form of claim in terms of remittance basis. Usually, you would look at two different calculations. You would look at the tax due if you were to just be taxed on worldwide income, and then you would also look at the tax due if you were to claim the remittance basis, whether there was a remittance basis charge included in there. Then that would also skew with my advice. So in this instance, go and get some sort of tax advice, have some tax planning, and for the first 3 years or 4 years or 5 years whilst in the UK, it might be beneficial to claim the remittance basis on the basis that you're not going to remit this income to the UK. And then following that, if your income or total tax is, let's say, less than 30k on that income, then you wouldn't claim the remittance basis because you'd have a charge of 30k instead of remitting that income. So again, it's lots of different elements, and I would suggest getting some sort of personalised advice on that one. Next question, please, Leon.
Yeah, no worries. So the next question is, my husband is not resident in UK. He is in Hong Kong. He gives money to me for cost of living monthly through my Hong Kong bank account, and then I transfer the money to my UK bank account. Is or isn't need taxation?
So from that one, we're looking at the husband not being resident in the UK, effectively giving gifts, cash gifts to this person who is UK resident, but transferring it first into a Hong Kong bank account, which is, I'm assuming, in your name, and then you're transferring it from Hong Kong to the UK on that basis. So in terms of cash gifts, if the cash gift was just sent directly to your UK bank account from your husband in Hong Kong, as far as I'm aware, I would double check on this, that there is no income tax chargeable on those cash gifts. However, because you are first transferring it into a Hong Kong bank account, then it would raise a question as to what income or what monies does that Hong Kong bank account consist of. If you've got a mixed bank account, such as you have claimed the remittance basis and you've got some sort of pension income in there, gains income in there, etc., then that would potentially be taxable because you can't choose which of the income is being transferred from a mixed bank account. So again, it's all about pre-planning bank accounts prior to arriving to the UK, because it can be very tricky once you are here and the rules are quite specific. So in terms of cash gifts directly from your husband to you, then no. But if you are transferring to a Hong Kong bank account and in that Hong Kong bank account there's a mixture, then there potentially may be somewhat of tax consequences. So get some advice. Moving on towards the end now, and we have got poll 3. Have you heard of making tax digital for income tax and self-assessment? For all those that are foreign and have somewhat of an interest in UK property, then you will fall within this scheme from April 24 if your income exceeds, gross income should I say, exceeds 10k. So it's worthwhile understanding what new reporting requirements will be required, and hopefully making sure that you've got all the necessary actions in place. So for those that are doing paper returns, unfortunately, if you've got somewhat of UK property income or self-employment income of over 10k, you'll have to go digital on that basis. So just publishing this result, and no, not heard of this, which is 50%, 54%, which is quite high. So I would be surprised if we don't end up looking at this at some point. This Making Tax Digital thing comes in from April 24, like I've just mentioned, and anybody with gross income, rental income of 10k or more will fall within this regime. So if you haven't heard of that and that is relevant to you, then it is worthwhile checking any future webinars on this topic with us. Yes, but not made preparations at 22%. And then, yes, I have a plan in place at 16%. And yes, but I don't think it will matter to me, is 8%. So great. So live demonstration, I have spoken way too long, and I will send, or I will ask Leanne to send out, or Anna, a couple of links of a recording for myself doing this sort of thing, so you can have the joys of seeing Go Simple Tax in action. For those that currently use paper returns, hopefully you'll see this as more beneficial, and for anybody that doesn't use it, hopefully it simplifies your tax return submitting experience. So no live demonstration, unfortunately, but there will be a couple of links of recordings going out shortly. So I know that we've gone over the hour mark, but there's a couple of questions. So if people want to stay on, then we're just going to go into questions now. Hopefully your question gets answered, but I'll only be doing a handful, as I know that people in certain countries are it's getting on quite late. So Leanne, if you can just ask let's say a handful of questions, including the one on the screen, then we can
Yeah, no problem. Just before we do, for those who might have missed the start, there has been a high number of questions submitted already, which you'll see in the Q&A section. If you go through, you can see which ones have been asked already. That's on the top left of your screen. We'll go through as many questions as we can, which unfortunately will only be a handful because we're running out of time. So just please note, any complex cases will not be able to comment on, and would advise you to seek tax advice. Okay, so this first question on screen is, can non-UK residents use the Go Simple Tax software to report UK incomes themselves without using a tax agent?
Yes. So I think even you could answer this one, Leanne, couldn't you? But
Maybe.
so I basically had this after the live demo because I was going to show this specific question, and the answer to that is yes. If you're a non-UK resident, you can use Go Simple Tax software to report UK income. So yes, the answer to that one is yes. So now we're just going to pop on to the handful of questions which I think you sent in the chat earlier. Leanne, if you can
Yeah.
ask each one.
No worries. Like I say, we'll just do a couple because of the time.
Yeah.
So the first question is, I will have a mix of UK-based PAYE income and foreign income during the 22-23 financial year. I think I understand that I will need to do a self-assessment. What options would be available to me to minimise tax exposure, and what steps would you recommend to help prepare? Am I able to claim expenses such as travel and sustenance against my income?
So in terms of this, it is not a straightforward answer because I don't know the full background of your um, situation, like if you are UK resident but not domiciled, and how much foreign income you have, how long you've been in the UK, all those sort of factors need to be disclosed, and that's why I can't answer some questions because there's just not enough information. But on the assumption that you are UK resident, you are UK domiciled, non-UK domiciled, and the foreign income is, let's say, £10,000, then in terms of the PAYE income, that's just reportable anyway. The foreign income would mean that you need to complete a tax return. And in terms of the claims expenses such as travel and subsistence, then it would completely depend. If you are here on a temporary workplace basis, then yes. If you aren't and your contract is you work in an office and that is your primary workplace, then travel is a no. If you work in an office and you go and visit clients, then travel is yes from the office to um, the clients. So it's there's so many different answers to that depending on your personal circumstances. So hopefully I've covered your specific circumstance, but if not, then again, it will be speaking to a tax advisor because unfortunately there's not enough information on that one.
Okay, thank you. The next one is, I have a freelance job in Hong Kong and I'm paid in Hong Kong dollars through my Hong Kong account. Should I do self-assessment or should I inform the UK Treasury via another channel? Thank you for your help.
So, in terms of this, again, I don't know a background of yourself. On the assumption that you are UK resident, then technically you're doing a freelance job, let's say remotely. Then, because you are UK resident, you would be taxable on worldwide income, and therefore you would need to convert the Hong Kong income into Great British pounds and report that on the SA 103 self-employed pages. That's on the assumption that you're UK resident. If you're not UK resident, then because it's foreign income, it's not taxable because you're not taxable on worldwide income. You're only taxable on UK sourced income. But yeah, so only need to inform HMRC if you are UK resident, and you would be taxable on worldwide income.
Okay, thank you. Next one is pension received monthly from foreign country taxable? Do I need to report them on the tax returns?
Again, I'm not too sure on your residency or domicile, but on the assumption that you are UK resident, then you would be taxable on worldwide income, and therefore, yes, you would need to report them on a tax return, provided that you have got one due. If you are non-domiciled and the pension income isn't being remitted to the UK and is quite hefty, then it might be worthwhile looking at a remittance basis claim. Again, I don't know the information and background to your tax affairs, so I can't give a exact answer.
Okay, I think we'll just do one more because time is ticking on, and I think this one might be quite interesting with the current that's going on over here in the UK. So with growing interest rates in the UK, I have taxable interest to declare there. Can I claim the personal savings and starter saving allowances?
So these allowances are just an automatic. So provided that you are completing a tax return, any interest that is received in the UK would fall within these personal savings allowance and starter rates, depending on other income. So yes, you will be able to claim them, but it's on the assumption that it's automatically claimed anyway on a tax return. Probably worthwhile doing the next one as well. Or do the next two. Just do the next two.
Okay, no problem. So the next one is, where can I find the FX rate for converting my foreign income, saving interest, dividend and capital gain to GBP for tax returns?
So in terms of the conversion rates, HMRC have spot rates on their website. Literally type in HMRC exchange spot rates and you'll see either a monthly or an annual one that you can use. If you wanted to just use the average for the year, click on the spot rates for 31st of March 2022, let's say for the 21-22 tax year. Or if you want to be specific, you can go into the monthly spot rates and each individual let's say interest payment, you can then convert in the actual month rate.
Okay, this next question's in two parts, so I'll do the first part and then let you answer and then ask the second half. So I'm selling some property in Russia and want to send the money to my daughter, the UK citizen, to give her an opportunity to buy her own house. I will estimate as that 2 million plus US dollars.
200,000, I think.
200,000, sorry.
Right.
Couldn't count the zeros in time, would not pre-read the question. What taxes will she pay from that amount? Or is it better to send the money to my name and buy the property for our two names to avoid big tax? She pays now 20% from her salary. That's the first part of the question.
So in terms of that, I did mention it on the webinar, but it is worthwhile mentioning it again. So as this seems to be a cash gift, I'm assuming there'll be somewhat of tax to pay in Russia on the sale of the property. If there is no capital gains tax on asset sales, then there'll be no tax on that one. But then as it's a cash gift to a UK citizen and you are non-resident, then there would be no tax implications on this. I've checked HMRC's community forum and that is confirmed multiple times that cash gifts are not taxable. However, if it's sent to a bank account and interest is created from that money being set in a bank account, then the interest would be taxable in the UK.
Okay, you may have just covered that bit for the second part. How much money per month, per year can I give her as a gift, not make her to pay tax from that amount?
Yeah, so again, same thing. Provided that it's a cash gift from a non-UK resident to a UK resident, then effectively there is no income tax complications unless there is somewhat of interest that is then generated from having that money in a bank account, or if that £200,000 is invested in, let's say, stocks, and then dividends are generated from them stocks, then yeah, that would be taxable as well.
Okay, brilliant. Okay, so we'll have to draw the webinar to an end as time is unfortunately against us. And like you said earlier, there is quite a few people out there that it will be quite late at night, and I'm sure they're getting tired. Again, any questions that we've not replied to here, we will do so via email. I'll put some support tickets through and Aidan or the team will get back to you. So thank you for joining us today. Have a wonderful rest of the day, whatever you're doing, and goodbye.
Thank you, everyone.